Ah, Wall Street, Las Vegas for rich people. We've all fantasized about being the next Gordon Gekko or Jordan Belfort, but the average Joe's odds of beating the market may actually be lower than leaving the Bellagio in the black. That doesn't mean it can't be done. This is Epic How To.
Epic How To.
When investors talk about beating the market, they're talking about beating the S&P 500, an index of 500 stocks that represent the overall performance of the market. If the S&P index is up 6% from the last year and your portfolio is up 6.1%, technically, you've beaten the market. Sounds easy, right? Wrong. Studies show that a mere 1% of investors manage to beat the market. Recent investment theories suggest that success in the stock market may be entirely random, so random that a couple of kids can do it. Take Timothy Go and Ethan Mockletter, two 9-year-olds who made a 50% return on their investment in a virtual trading competition, doing better than professionals with decades of experience. So how do you make your millions? Well, be patient. If you're looking to make a lot of money quickly, your odds are slim. But if you're looking to make a slow and steady profit in the long term, you can beat the market with these steps. You'll need an initial lump sum to invest, and the bigger the better. So be nice to your great Aunt Lucille and make sure you're in on her will. Give her an extra. One option for your lump sum is to go into foreign exchange trading. Basically, the foreign exchange market trades currencies between countries. So if right now $2 American gets you 1 British pound, then sometime later you sell that pound back for $2.50, then you made a profit. This can be very tricky and is difficult to predict. Plus, you're essentially hoping for other countries to do so poorly that you can profit off of their economic collapse. So let's just talk about the traditional market. When learning the basics of investing, remember the most basic principle is to research and use data rather than rely on a gut feeling. You want to always be reading books and watching financial news networks so you can make informed decisions rather than emotional ones. Set up a virtual account to practice. This is also called paper trading, and you can set up free virtual accounts at a variety of websites. The best way is to learn by doing, so experiment and try out different strategies before you actually put your own money on the line. Once you've made some virtual money, you might think it's time to finally buy some stocks. But first, you need to assess your risk tolerance. All investments, no matter how small, come with a certain amount of risk. So before you go all in, be sure to consider your age and life circumstances. A single 30-year-old who loses it all still has plenty of time to rebuild wealth before retirement. A 60-year-old, not so much. The most cost-effective option is to go with an online trading platform you control yourself. If you trade through a professional broker or advisor, they're going to charge management fees that will eat into your profits. These extra costs are one of the major reasons that investors don't beat the market's rate of return. So what stock should you invest in? Investment legends like Peter Lynch and Warren Buffett say to always buy what you know, so look at companies and industries you're familiar with. For example, if you're a doctor, you're better off buying stock in a pharmaceutical company than, say, a sunglasses retailer. Being familiar with the industry you're investing in gives you a leg up over other investors trying to predict how the stock's going to perform. Don't just pick blindly out of a hat. Do some homework. Read quarterly reports and look at the company's debt ratio and look for a low price to earnings ratio, meaning the stock price is relatively low compared to the actual earnings of the company. Take note of any upcoming product releases, technological breakthroughs, pending patents, and mergers or acquisitions that could make the stock more valuable. But in reality, all sorts of things can affect the prices of stocks, including the day of the week. As an article from The Economist points out, prices of stocks tend to raise slightly at the end of the month and the first 3 days of a new month. They also rise on Fridays and fall on Mondays. Why? Who knows? Mondays suck. Seriously, our entire country's economy is based on guesswork. Just want to remind everybody of that. Which brings me to our next point. Don't limit yourself to American companies trading on the NASDAQ and the New York Stock Exchange. The OTCQX is another exchange that trades the stocks of many foreign and smaller companies. Many successful companies like Nintendo, Volkswagen, and Nestle trade on the OTCQX, simply because they don't want to pay an American legal team to get them on the bigger exchanges. China in particular is starting to make more and more stocks available to American investors on the OTCQX, and savvy speculators are taking advantage of the new offerings. But don't go crazy. Limit the number of companies you're invested in so you can keep track of them. And for each stock, have a specific dollar amount that you'll buy and sell at, but be flexible to adjust for new developments. If your stock has reached your original selling price, but the company is on the verge of releasing a promising new product, you might want to hold on to your shares. You need to closely monitor your stock's price fluctuations. This can be a demanding task. Some speculative investors even quit their day jobs and become day traders, making fast trades in small, volatile stocks all day. Some will only hold a stock for minutes at a time. But even if you're not a day trader, you need to watch price fluctuations on a regular basis so you can sell if there's a sudden gigantic increase in price. It's your only chance to make a fortune overnight. Don't blow it. A lot of this advice has been telling you to do what other people do, but some of the most successful investors do the exact opposite of what the general public is doing. If people are selling, they buy at a lower price. If a lot of people are buying, they sell, and then they cash out at an inflated price. It takes a lot of guts to go against the grain, but the rewards are well worth it, sometimes. By making smaller investments, letting them build over time, and trusting in the system, you'll make a sizable nest egg. It may not be as exciting, but just like a certain tortoise and hare, you know the story. Slow and steady wins the race. And you won't be contributing to the next economic global depression. So that's nice. Congrats! You've invested wisely and you're making money on the stock market. You can finally buy that big gold boat you've always dreamed of. Maybe once you've paid off your student loans. It won't suck. Until then, this has been Epic How To. Let us know what topic you guys think we should break down next in the comments below, and don't forget to subscribe.